So good morning, guys. We're just going to continue with chapter 1, and I'm sure we'll finish it off in this part. So yesterday we were talking about the difference between bookkeeping and accounting. Bookkeeping is basically where you record transactions, and accounting is where you take those recorded transactions in a summary form using a trial balance, and you create financial statements, you meet with clients, you communicate all that information, and you also interpret and analyze that information. Moving to the services that accounting firms provide, we have compilation, review, audits, tax, and business. Compilation is where the accountant takes all the info from the client and produces the statements based solely on the information that the client has provided. So the accountant is taking no responsibility. Review is where they review information that the client has provided, so they share responsibility, and audits are where the responsibility is more on the accountant, but of course the responsibility is still there with the client because it is the client's information. So we also talked about some of the GAAP, like the cost principle, the going concern assumption, the monetary unit, and the economic entity. So cost principle states that you must record all the assets at historical cost. Going concern assumption is where you're assuming that everything will be fine in the future, the company is going to be running. The economic entity assumption is stating that you must separate your personal assets from your company's assets, and they are two different economic entities. And then you obviously only record transactions which are financial transactions. So what is an asset? An asset is something that you must own and that must have an economic value. So just something that you own doesn't mean that it has an economic value. It has to have an economic value for it to be called an asset. And liability is something that you owe to others that has an economic value. So again, it cannot be anything that you don't that doesn't have an economic value. It must have an economic value. So for example, if you owe someone $10, there is a liability that you have for them. Owner's equity is the difference. This is the difference between assets and liabilities. This is the fundamental accounting equation. Highlight it, circle it, do something with it. Assets equal liabilities plus owner's equity, or you can rewrite it by saying assets minus liabilities equals owner's equity. So it's all the same. It must balance. This is a fundamental equation. It needs to balance in order for your statements to be accurate. So this next slide just shows what are the differences. How owner's equities are increased or decreased. So you can see that owner's equities are usually increased if the owner puts more money into the business. That means that equity is going up. Now, if there are revenues, equities go up. However, if there are expenses, equities go down. So of course, every business has expenses, right? So revenues increase equities, expenses decrease equities, and obviously withdrawals by the owners also decrease equities. There are a few other notes on it too. We'll come to that as we go along in the course. So what financial statements are we talking about? We have 4 financial statements. We have income statement, we have balance sheet, we have statement of owner's equity, and we have statement of cash flows. Revenues are a statement of income statement. Income statement gives you revenues and expenses listed during the year. Balance sheet, as I had mentioned earlier, gives you balances of all the assets, liabilities, and equities at a given point of time. So income statement is like a video where it has a beginning and an ending. A balance sheet is like a photograph where you are taking a picture, a snapshot of all the company's assets, liabilities, and equities at a given point of time. Statement of owner's equity is basically the differences between assets and liabilities and changes in equity from prior year to current year. Statement of cash flows gives you info on all the cash coming in and all the cash going out. We'll talk about these statements in future as well. So just to sum it up, we have 4 financial statements. We have talked about the accounting cycle. We've talked about the difference between bookkeeping and accounting. We've talked about some of the accounting services. We've talked about some of the accounting principles, and we have also talked about the fundamental accounting equation, which is assets equals liabilities plus owner's equity. I cannot emphasize that enough. You must repeat it as you go home or as you look at the slides. Just ensure that you know assets equal liabilities plus owner's equity. Thank you.